Welcome to another episode of the Washington Retirement Planning Podcast. I'm your host, Ethan Meikle, and I specialize in helping Washington State employees get more educated on their retirement benefits so they can retire earlier, pay less in taxes, and enjoy more free time with their loved ones. Today's episode, we're talking about how does Plan 3 get taxed? So initially, this question came in from a longtime client of mine who has been planning Plan 3 for about 18 years now, but he's just so confused about how the money's going to be taxed when he eventually pulls it out. So today we'll dig deeper into how does it get taxed, but also what other tax implications can occur from it. In other words, how does taking money out from Plan 3 affect me not only from a tax standpoint, but how does it affect my other retirement benefits? How can my taxes change if tax rates change? We're going to dive into all of that. Before we get started, remember that if you head over to washingtonterspers.com, it's my free blog site. I have tons of free content on there, guides to download, and that's going to be the host of my next course that I'm currently building out. Part 1 of that course will be available for free on that website. So be sure to visit that website and to check that out. Now, as far as how does Plan 3 get taxed, first we have to take a step back and figure out what kind of account is it. So a lot of people will assume that the Plan 3 is a 401k or an IRA, and really it's its own thing. It's actually technically a 401a, which is a defined contribution plan. The state defines how much you can, put into it. So these accounts, they have special rules that are different from 401ks and you have in the IRAs. But ultimately, from a tax standpoint, this account is 100% pre-tax, which means that every dollar you put into this account over the course of your career, plus any interest you earned or growth you saw in the account, is still subject to taxes. So even if you only contribute yourself $100,000 to this account, and it's worth $300,000 today, which means you have $200,000 of growth, the entire thing is still taxable to you. Now, as far as when you pay taxes on it, you're only taxed when you physically withdraw the money. So if you were to take this money and you say you transferred it into the TAP annuity, you transferred it into your own IRA, anything like that, transfers are not taxable events. You're not spending the money, you're just simply moving them to a different account. That you can do without any type of tax consequences. Now, they still generate tax forms, which basically informs the IRS that you move the money, but it's not taxable. Now, when you actually pull the money out to spend it, that's when taxes occur. So if I took $10,000 out of my Plan 3 account, I would have to pay taxes on that $10,000. How much taxes I have to pay will depend on what bracket I'm in, or where my income level is at. So let's just assume I'm in the 22% bracket. So I'm in retirement, I got my pension rolling in, I got Social Security, whatever other income comes in, and I'm basically in the 22% bracket, which means every dollar I take will be taxed at that 22% rate. So if I took $10,000 out and I was on that bracket, I'd owe 22% of that $10,000 or $2,200. So you would net about $7,800 from that transaction. Now, a lot of people don't want, if they want $10,000, they always think in terms of abstract money. So if you wanted to net or take home that $10,000 to actually spend, that's what you're trying to purchase, you'd have to take out more than $10,000, right? We'd have to account for taxes. Now, logically, you say, hey, if taxes on $10,000 is $2,200, I'll just take out $12,200. They'll take the IRS will get $2,200. I'll keep my 10 and they're all square. But that's not how that works. Because now you took out more money, you took out $12,200, not $10,000. Now you owe taxes on the $12,200, not just the $10,000. So you actually owe 22% on that number. So your actual tax bill is now just under $2,700, about $2,684 or so. So now you still have less than $10,000. So actually, in order to calculate it, you have to take how much you want to take home from, and then always divide by 1 minus the taxes. So I take 1 minus 22 or 0.22, I get 0.78. If I took 10,000 divided by 0.78, it gives me 12,820. So I'd have to fill out the paperwork for 12,820. The government would get the $2,820, and I would get and I would actually net the 10,000 at that point. So you see, just because I took out a little bit of more money to cover the taxes, it incurred me more taxes. So you're paying tax on the taxes. So it's a really sticky situation that people can find themselves in. So while pre-tax can be good in some situations, that's why it's important to have other taxable accounts that you can avoid paying taxes on because you already paid them. You're not really avoiding it. So if you had like Roth or after-tax money accounts, money in the bank, that money comes up free and clear. That's not the way it works inside of these pre-tax accounts. Now, as far as, how do I actually report the taxes? Anytime you take money out of any type of retirement account, whether it's Plan 3, IRA, you're going to get a 1099-R. So it's just a form that says so-and-so took out this much from taxes. And the form just lets the IRS know how much you withdrew from your account and how much taxes are withheld. So keep in mind that you do have the option to always just pay the IRS directly via estimated payment. So if you didn't want to have taxes withheld from your Plan 3 account, you could just send an estimated payment to the IRS directly. What would that do for you? Well, if you take the $10,000 out straight from Plan 3, the tax bill, like we mentioned earlier, would be $2,200. You used an estimate payment of $2,200. Remember, if you took it out of that, if you had taxes withheld from the $10,000, your total would have been closer to $2,800 in taxes paid. So it saves you about $600 just from paying from your savings account. And instead, however, keep in mind that the IRS treats estimate payments differently than they treat withholdings. So withholdings get preferential treatment. Doesn't matter what month or what quarter the taxes are withheld, they're just considered evenly spread throughout the year. Estimate payments, they have quarterly deadlines on it. So if you took $10,000 out, let's say in May of a current year, that is in Q2, which means the estimate payment has to be paid by June 15th or right around there. Now, if you are late, like you forget to make this payment or you're like, I'll do it at the end of the year, the IRS could, not always, but they could technically hit you with a late payment. And so because you didn't pay it in that quarter the withdrawal is due, if you didn't hit the safe harbor number, it's something that could happen. Now, the safe harbor number is just a calculation that can be done. Basically, it says, if you pay at least this much in taxes, they guarantee you no penalties, no late penalties or underpayment penalties, basically. But that's a topic for another day. Now, it's important to also keep in mind that the taxes that you pay on it also depend on when you take it. So if you took it before age 55, let's say you separate service at 53 and said, hey, I need to take this money out now, because you're not 59 yet or 55 into the Plan 3 system, you would then have to pay a penalty on top of that money. So they have 10% added on to it. If you took the Plan 3 money and let's say you moved it to the IRA, now you can't touch the money until 59 and a half. So one of the biggest mistakes that see people make in early retirement, and a lot of times it's the advisors that tell them this, is let's say someone retires at age 56, 57, and they move Plan 3 into the IRA because they want to manage it themselves. Well, now that it's in an IRA, you have to follow their rules, which means no access to 59 and a half. So you went from having access to not having access. If that's your plan, you have other income, don't need the money, that's great. But a lot of people don't realize there's that rule change when switching over from Plan 3 to an IRA. Most advisors aren't going to know about it because they don't work within the Plan 3 system. And if they're just trying to get paid, most of them can only get paid by managing money. Therefore, they have to move it to the IRA for them to get paid. They're not going to talk about the loss in access or the added 10% penalty should you need or access that money, which is why anytime I retire someone, I leave the money in Plan 3 or I leave it inside of their deferred comp until we reach at least age 59 and a half or age 60 before you even think about moving it over. So it's important to note that as taxes go up, so will your tax bill in that account. So if you have $500,000 in Plan 3 and you say, hey, I owe 20% to the government, therefore they get 100,000 of this, so the 400,000 is mine. If that tax bill goes to 30%, now you have less. Now you only have about 300,000 in change. So you basically have less money just because the taxes went up. So anytime our tax system changes, it has a direct impact on how much of your Plan 3 balance you technically get to keep. Now the other part is how you take it. So if you were to take it all up front, you took all 300,000 day one because you wanted to do something with it, buy something, move it somewhere, move it to savings account, something like that, that all count as income. So now you have $300,000 of income showing up on your tax return in addition to anything else you earned that year. Most times it's going to put you in one of the higher tax brackets. You're going to be in that 35, 37% tax bracket range. So you're going to lose a good chunk of your savings if you did that. Now, if you did that, before age 55 or you moved to an IRA and took it out and it was before 59, did add a 10% off of it. So instead of paying 37%, you pay 47% in taxes. So you lose almost half of your account value with that one move. So a lot of times people say, how is this taxed? It really depends on how you're going to take it. If you take it all out in a lump sum before 59.5, you could very well lose almost half of it, even in today's current low tax environment. So you can see money inside of Plan 3, while it is taxable, the amount of taxes you can pay can vary from year to year depending on what rates are and how you take it, when you decide to pay taxes, if you decide to pay taxes directly from the account, or if you're going to make extra payments on your own. But the main point I want to highlight is the longer you leave money sitting in Plan 3, and the bigger that account grows, the larger your tax bill does. So it's very important to take action and start doing steps to actively seek a tax strategy to pay the least amount that you can. So one of the worst things so what most people do is they retire and they have $300,000, $500,000 and they let it sit in Plan 3. They move to an IRA and they let it sit there. They do no active planning. The account continues to grow. And when they get to RMD age, they get hit with a massive tax bill. So you don't want to have that happen. You want to be proactive in your tax planning strategies. In fact, active tax planning is one of the simplest things you can do that has the biggest impact on the amount of taxes you'll pay over the course of your lifetime. So if you're ready to get started in tax planning, you don't want to wait till it's too late. You want to get on top of things now, then I encourage you to book a call with our office. We specialize in with teachers. Tax planning is what we do a lot of. Roth conversions is a real sweet spot of ours. So if you have questions on the topic, if you need help applying the topic, if you want to make sure it gets reported correctly, or you need recommendations to CPAs to help you execute the strategy, we can help you with all of that. So the link to our calendar is going to be in the description or the show notes below this episode. Also remember that if you need help with the investment portion inside of Plan 3 or Deferred Comp, we built out a system that will help you make all of those different investment decisions. We'll tell you exactly which funds to hold and when to make changes to you, all personalized to your situation. If you need more information on that, the link is in the description below. All right, that's it for this episode. I'll catch you guys all next time. Remember that your future depends what you do today. All right, before I sign off, just a real quick legal disclosure that we're required to say as licensed fiduciary advisors. So remember that this is a podcast. It is designed for educational and entertainment purposes only. I don't know you personally, therefore I cannot give you any personal advice. So please don't take anything that we say on the show as being personal, financial, legal, or tax advice. If you want that kind of stuff, make sure you seek out a professional so they can help you with the strategies and investments that are right for you. Also, please remember that despite the name of our show, we are in no way associated with Washington State or the Department of Guidance Systems or any other Washington employer. We're a private-owned firm that specializes in working with Washington State employees, which is why we know so much about this stuff. So remember, we don't work for the state in any way, shape, or form, so please don't confuse us as being an official representative of the state. All right, that's it for the legal stuff. I'll catch you guys all next time.